I have watched the retail industry transform more dramatically in the past 20 years than in the previous 100. Department stores that once anchored every shopping mall in America have filed for bankruptcy. Specialty retailers that seemed unstoppable have vanished entirely. Names that were household words for generations, Sears, JCPenney, Toys R Us, Radio Shack, have been reduced to cautionary tales about the dangers of failing to adapt. And behind almost all of this destruction stands one company. Amazon now. I want to be clear about something from the start. Amazon is one of the most impressive businesses ever built. What Jeff Bezos accomplished, taking an online bookstore and transforming it into a company that dominates e-commerce, cloud computing, and increasingly every other sector it enters, is nothing short of remarkable. If I had understood the business better in its early days, I would have invested. That I did not is one of my bigger mistakes. But my admiration for Amazon does not blind me to its impact on other businesses. Amazon has been a wrecking ball through the retail industry. Its combination of low prices, vast selection, and unmatched convenience has fundamentally changed how consumers shop. And any retailer that cannot offer something Amazon cannot replicate is living on borrowed time. This is the reality that investors need to understand. Most retail stocks are not going to survive the Amazon era. They are going to slowly bleed market share until they either go bankrupt or become irrelevant. Buying these stocks is not investing. It is waiting to lose money. But here's what most people miss. Not all retailers are doomed. Some have built competitive advantages so powerful that Amazon cannot replicate them. Some serve customers in ways that e-commerce simply cannot match. Some have business models that actually benefit from Amazon's existence rather than being threatened by it. Today, I am going to share with you the only 4 retail stocks I believe will not just survive the Amazon era, but thrive in it. These are businesses with genuine moats, businesses that will be more valuable 10 years from now than they are today, businesses that can compound wealth for patient investors regardless of what Amazon does. Let me start by explaining what it takes to survive in retail when Amazon is your competitor. First, and most importantly, you need to offer something that cannot be delivered to someone's doorstep in a cardboard box. This sounds simple, but most retailers fail this test completely. If you are selling products that Amazon also sells, and you are competing primarily on price and convenience, you have already lost. Amazon will beat you on both dimensions, because they have scale advantages and logistics capabilities that no other retailer can match. Second, you need a cost structure that allows you to remain profitable even as Amazon compresses margins across the industry. Many retailers operated for decades with fat margins built on information asymmetries. Customers did not know what things should cost, so retailers could charge whatever they wanted. Amazon destroyed this by making price comparison instant and universal. Any retailer whose business model depended on customer ignorance is now in serious trouble. Third, you need a reason for customers to be loyal that goes beyond price. If the only reason someone shops at your store is because you are cheaper, you will lose them the moment Amazon offers a better deal. And Amazon can always offer a better deal because they are willing to sacrifice profits for market share. You need customers who choose you, even when you are not the cheapest option. Fourth, you need a management team that understands these dynamics and is making the investments necessary to compete in this new world. Many retail management teams are still operating like it is 1995. They are focused on same-store sales comparisons and real estate optimization when they should be focused on customer experience and supply chain efficiency. These companies are dead men walking with these criteria in mind. Let me tell you about the first retail stock that will survive the Amazon era, Costco. I have studied Costco for decades, and it remains one of the most impressive retail operations I have ever seen. The business model is deceptively simple. Charge customers an annual membership fee, then sell them products at prices barely above cost. Make your profit on the membership fees, not on the merchandise. This model creates a virtuous cycle that is almost impossible to compete with. Because Costco makes its money on memberships, it has no incentive to inflate product prices. In fact, Costco is religiously committed to keeping prices low. They cap their markup at 14 or 15%, and on many items, the markup is even lower. This discipline has been maintained for decades across multiple management teams. The result is that Costco customers trust the company implicitly. They know that if something is for sale at Costco, the price is fair. They do not comparison shop. They do not pull out their phones to check Amazon. They just buy. This trust has been earned over decades and cannot be replicated quickly by competitors. Now here's where it gets really interesting from an Amazon perspective. Costco is actually a beneficiary of Amazon's rise rather than a victim of it. Think about what Amazon has done to retail. It has trained consumers to expect low prices and convenience. But Amazon cannot replicate the Costco experience. Amazon cannot let you walk through a warehouse and discover products you did not know you wanted. Amazon cannot give you free samples of food that might become your new favorite. Amazon cannot sell you a rotisserie chicken for $4.99 or a hot dog and soda for $1.50. These might seem like small things, but they create an experience that drives customer loyalty. Costco's membership renewal rate is over 90%. That means once someone becomes a Costco member, they almost never leave. They keep paying that annual fee year after year, decade after decade, and the membership fee itself is a competitive moat. Once you have paid $60 or $120 for an annual membership, you have a strong incentive to shop at Costco to get value from that investment. This creates switching costs that do not exist with other retailers. The economics of this business are extraordinary. Costco generates over $4 billion per year in membership fees alone. This is essentially pure profit that funds the entire operation. The actual retail business runs close to break even, which allows Costco to maintain the lowest prices in the industry. Amazon has tried to compete with Costco through various initiatives. They bought Whole Foods. They launched Amazon Fresh. They experimented with different formats. None of it has made a meaningful dent in Costco's business. Why? Because Amazon is optimized for convenience and Costco is optimized for value. These are different customer needs that can coexist. The second retail stock that will survive the Amazon era is Home Depot. Home improvement retail is one of the few categories where physical stores have inherent advantages over e-commerce. When you need lumber for a deck project or plumbing supplies for a bathroom renovation, you usually need them today, not in 2 days. When you are unsure which product is right for your project, you want to talk to an expert in the store who can guide you. When you are buying something large and heavy, you want to load it in your truck rather than pay for shipping. Home Depot has built an extraordinary business around these needs. The company operates over 2,000 stores across North America, each one staffed with knowledgeable associates who can help customers complete their projects. This expertise is not something Amazon can replicate with an algorithm, but what really sets Home Depot apart is how they have invested in their supply chain and technology to complement rather than compete with e-commerce. Home Depot was one of the first traditional retailers to truly embrace omnichannel retail. You can order online and pick up in store within hours. You can order from your phone while standing in the store if the item you need is not on the shelf. You can return online purchases to any physical location. This integration creates a customer experience that Amazon simply cannot match. Home Depot combines the convenience of digital shopping with the immediacy and expertise of physical retail. And for home improvement projects, which are often urgent and require guidance, this combination is incredibly valuable. The competitive dynamics of home improvement retail also favor incumbents. Building a home improvement store requires massive capital investment. Each location needs to stock tens of thousands of items, many of them bulky and expensive. You need real estate inventory and trained staff. And you need density of locations because customers want a store within a reasonable driving distance. Amazon could theoretically build this infrastructure, but why would they? The capital requirements are enormous. The margins are modest, and Amazon's competitive advantages, data, and logistics. are less relevant in a category where customers need products immediately and often need help selecting them. The third retail stock that will survive the Amazon era is AutoZone. This might seem like an unusual choice, but bear with me. AutoZone operates in a niche that is essentially immune to Amazon disruption, and they have built a business model that generates extraordinary returns on capital. Think about when you need auto parts. Your car breaks down. You need to fix it today, ideally within the next few hours. You do not know exactly which part you need because you are not a professional mechanic. You need someone to help you diagnose the problem, identify the right part, and maybe even help you install it. Amazon cannot do any of this. They can sell you an air filter or wiper blades that you plan to buy in advance. But for the urgent diagnostic service-oriented needs that drive most auto parts purchases, you need a physical store with knowledgeable staff. AutoZone has built exactly this. Their stores are staffed with people who can help customers figure out what is wrong with their vehicles and which parts they need. They offer free diagnostic services. They loan tools for DIY repairs. They even help install certain parts like batteries and wiper blades. This service component creates customer loyalty that Amazon cannot replicate. When your car will not start and you do not know why, you do not go to Amazon, you go to AutoZone. The economics of the business are remarkable. AutoZone has generated returns on invested capital above 20% for years. They buy back massive amounts of stock, reducing the share count by half or more over the past decade. This means that even if the business only grows modestly, earnings per share grow much faster due to the shrinking share count. The company also benefits from the aging of the vehicle fleet. As cars get older, they need more maintenance and repairs, and as vehicles become more complex, fewer people are capable of doing their own work, which drives them to AutoZone for help. These trends are tailwinds that will persist for years. Amazon has made some attempts to enter the auto parts business, but they have gained minimal traction. The category is simply too service-intensive, too urgent, and too reliant on local inventory to work well in an e-commerce model. The fourth retail stock that will survive the Amazon era is Walmart now. I know what some of you are thinking. Walmart is the most obvious Amazon competitor. How can I be confident they will survive when so many other retailers have failed? Let me explain what makes Walmart different from the retailers that Amazon has destroyed. First, Walmart has scale that approaches Amazon itself. They operate over 10,000 stores globally and generate over $600 billion in annual revenue. This scale gives them purchasing power that allows them to compete on price with anyone, including Amazon second. Walmart has made massive investments in e-commerce and technology. Unlike retailers who ignored the digital threat until it was too late, Walmart recognized early that they needed to transform. They hired tech talent from Silicon Valley. They acquired e-commerce companies. They built out their digital capabilities aggressively. Third, and most importantly, Walmart has something Amazon is still trying to build: a massive network of physical locations within a short drive of almost every American household. This network is an asset that cannot be replicated quickly or cheaply. Think about what Walmart can do with these locations that Amazon cannot. Same-day pickup for online orders. Same-day delivery using stores as distribution points. Easy returns of online purchases. Fresh grocery pickup where you order online and someone loads the groceries into your car. These services combine the convenience of digital shopping with the immediacy of physical retail. Grocery is particularly important. Grocery shopping is the most frequent retail activity for most households. People buy groceries every week. And while Amazon has made inroads with delivery services, many consumers still prefer to shop in person for fresh items like produce and meat. They want to see the quality before they buy. Walmart has invested heavily in grocery, including pickup services that let customers order online and collect their groceries without leaving their cars. This service has been enormously successful because it offers convenience that even Amazon cannot match. You get your groceries in minutes, not hours or days. The company has also made strategic choices about where to compete with Amazon and where to differentiate. Walmart is not trying to match Amazon's selection of millions of items. They are focused on the products that matter most to their customers, particularly in grocery and everyday essentials. By focusing on these categories, they can maintain lower prices and better availability than Amazon in the areas that drive most of their business. Now let me explain what these four stocks have in common and why I am confident they will survive when so many other retailers will not. All four of these businesses offer something that Amazon cannot replicate through e-commerce. Costco offers a treasure hunt experience and prices so low they seem almost irrational. Home Depot offers expertise and immediacy for home improvement projects. AutoZone offers diagnostic services and urgent access to parts. Walmart offers a physical presence in communities nationwide combined with digital convenience. All four of these businesses have cost structures that allow them to compete on price without sacrificing profitability. Costco makes money on memberships, not merchandise markup. Home Depot has scale advantages that keep costs low. AutoZone has optimized their supply chain to maintain high returns on capital. Walmart has purchasing power that rivals Amazon itself. All four of these businesses have invested aggressively in technology and digital capabilities. They are not pretending that e-commerce does not exist. They are embracing it and finding ways to combine digital and physical retail that create experiences neither pure e-commerce nor traditional retail can match. And all four of these businesses have management teams that understand the competitive dynamics they face. They are not deluding themselves about the threat from Amazon. They are making the hard choices and investments necessary to compete in this new world. Let me contrast these four with the retailers that have failed or are failing. Department stores like Macy's and Nordstrom, specialty retailers like Gap and Bed Bath & Beyond, electronics retailers like Best Buy and Radio Shack. What do all of these have in common? They sell products that Amazon also sells. They compete primarily on selection and price, areas where Amazon has decisive advantages. They have high cost structures built on expensive real estate and large workforces, and they have been slow to adapt to the digital transformation of retail. When you compete with Amazon on Amazon's terms, you lose. It is that simple. Amazon has advantages in technology, logistics, and scale that no traditional retailer can match. Any business that tries to beat Amazon by being more like Amazon is doomed. The survivors are the retailers who refuse to compete on Amazon's terms. They have found niches where physical retail has inherent advantages. They have built customer relationships that go beyond transactions. They have created experiences that cannot be replicated online. This is the framework you should use when evaluating any retail investment. Do not ask whether the company has a good product or a recognizable brand. Ask whether the company offers something that Amazon cannot replicate. If the answer is no, the stock is not worth owning, regardless of how cheap it looks. Let me share a story that illustrates this point. A few years ago, I was looking at a well-known specialty retailer. The stock had fallen significantly, and the company looked cheap by traditional metrics. They had a beloved brand, loyal customers, and a long history of profitability. But when I analyzed the business through the lens of Amazon competition, I realized it was a trap. The company sold products that Amazon also sold. Their competitive advantage was based on curation and brand, not on anything that prevented customers from buying similar products on Amazon for less money. Their cost structure was built for a world where customers visited physical stores, but increasingly customers were researching online and buying from whoever had the lowest price. I passed on the investment within 2 years. The company was in bankruptcy. The brand still exists in some diminished form, but shareholders were wiped out. This is the danger of retail investing in the Amazon era. Companies that look healthy by traditional metrics can be dying businesses. The warning signs are often hidden in the competitive dynamics rather than the financial statements. You need to understand not just how a company is performing today, but whether its business model is sustainable in a world where Amazon is always one click away. Now let me talk about valuation, because even great businesses can be bad investments if you pay too much. All four of the stocks I mentioned trade at meaningful premiums to the broader market. Costco in particular has always seemed expensive to traditional value investors. How can I recommend paying 30 or 40 times earnings for a retailer? The answer is that valuation has to be considered in the context of competitive position and growth potential. A retailer with a declining business should trade at a low multiple because its earnings will shrink over time, but a retailer with a growing business and a sustainable competitive advantage deserves a premium multiple because its earnings will compound over time. Costco has grown earnings at double-digit rates for decades. If they continue to do so, which I believe they will given the strength of their model, then today's seemingly expensive multiple will look cheap in retrospect. You are not paying for today's earnings. You are paying for decades of future earnings growth. This is a critical concept that many investors miss. They see a high price to earnings ratio and assume the stock is expensive. But if the business is going to grow earnings at 15% per year for the next decade, a stock trading at 30 times earnings today will be trading at 8 times earnings in 10 years based on current price. That is cheap by any measure. Of course, the growth has to actually materialize. This is why competitive analysis is so important. You cannot just assume growth will continue. You have to understand why the business will keep winning customers and generating profits. For the four stocks I mentioned, I have that understanding. I can see why their competitive advantages will persist and why their growth will continue. For most retail stocks, I do not have that confidence. Their competitive positions are eroding, their growth is slowing or reversing. Paying any multiple for their earnings is risky because those earnings may not exist in 5 or 10 years. Let me also address a common question I receive about retail investing. What about the death of physical retail? Everyone says that e-commerce is going to take over completely and physical stores will become obsolete. This is an oversimplification that will cost investors money if they believe it. Yes, commerce is growing faster than physical retail. Yes, some categories have shifted dramatically online, but the idea that physical stores will disappear entirely is nonsense. Humans are social creatures. We like to get out of our houses. We like to see and touch products before we buy them. We like experiences that cannot be replicated through a screen. Physical retail that provides these benefits will continue to thrive. What is dying is bad physical retail. Stores that are dirty and poorly staffed. Stores that offer no advantage over online shopping. Stores that exist only because customers did not have alternatives. These stores deserve to die, and Amazon has been the instrument of their destruction. Good physical retail is actually benefiting from this shakeout as weak competitors close locations. Strong retailers can capture their market share. Costco's growth has accelerated as competitors have struggled. Home Depot has gained share as smaller hardware stores have closed. The strong are getting stronger because the weak are getting weaker. This dynamic will continue for years. Every retail bankruptcy, every store closure, every struggling competitor is an opportunity for the survivors to gain share. The retailers I have highlighted are well positioned to benefit from this consolidation. I want to close with some thoughts on how to think about retail investing going forward. The Amazon era has fundamentally changed the rules. Strategies that worked for retail investors in the past no longer work today. You cannot buy retail stocks just because they look cheap. Cheap stocks in declining industries are not bargains. They are traps. The multiple will keep falling as the business deteriorates, and you will lose money even though you thought you were buying at a discount. You cannot buy retail stocks based on brand recognition. Brands that seemed invincible have been destroyed by Amazon. Sears was once the most trusted retailer in America. Now it barely exists. Brand alone is not enough to protect a business from existential competition. You cannot buy retail stocks based on historical growth. Past performance in retail is less predictive than in other industries because the competitive landscape has changed so dramatically. A company that grew for decades can collapse in years when Amazon enters its category. What you can do is focus on businesses with genuine competitive advantages that Amazon cannot replicate, physical experiences that create customer loyalty service components that require human expertise, urgent needs that cannot wait for delivery, low-cost structures that allow price competition without sacrificing profits. The 4 stocks I have shared today, Costco, Home Depot, AutoZone, and Walmart, all meet these criteria. They are not guaranteed to succeed. No investment is guaranteed, but they have the competitive positions necessary to thrive in a world where Amazon is a dominant force. These are the kinds of retail stocks I am comfortable owning for the long-term businesses that can survive and prosper regardless of what Amazon does. Businesses that will be more valuable in 10 years than they are today. Businesses that can compound wealth for patient investors through any economic environment. Everything else in retail is speculation. It might work out, the stock might go up for a while, but you are betting against one of the most powerful competitive forces in business history. And that is a bet I am not willing to make focus on quality. Understand competitive dynamics. Buy businesses that can survive the Amazon era. That is the path to building wealth in retail investing. Everything else is hoping that history will stop, that Amazon will stumble, that somehow the forces reshaping retail will reverse. Hope is not an investment strategy. Understanding competitive advantage is. And the 4 stocks I have shared today represent the best opportunities I see to own retail businesses that will survive and thrive for decades to come. Now I want to go deeper into why each of these businesses has staying power that most investors underestimate. Let me tell you more about the magic of Costco's membership model. When I talk to investors about Costco, they often focus on the wrong metrics. They look at comparable store sales growth or gross margins on merchandise. These metrics miss the point entirely. The genius of Costco is that the membership fee creates a relationship with customers that transcends any individual transaction. When you pay that annual fee, you have made a commitment. You have declared yourself a Costco member. This psychological commitment drives behavior in ways that benefit the business enormously. Members visit Costco frequently because they want to maximize the value of their membership. They buy more. Per volt ice it because Costco has trained them to expect exceptional value on everything in the store. They tell their friends and family about the deals they found because being a Costco member becomes part of their identity. Compare this to a typical retailer where each transaction is independent. Customers have no commitment to the store. They will go wherever has the best deal on any given day. There is no loyalty, no relationship, just a series of one-off purchases driven by price comparison. Amazon has tried to replicate this dynamic with Prime membership, and Prime is genuinely successful. But Prime membership is primarily about convenience, about getting things delivered quickly, and accessing streaming content. Costco membership is about value, about being part of a community that has access to exceptional deals. These are different emotional propositions that can coexist. I have watched Costco for decades, and what impresses me most is their discipline. They could easily raise prices and make more money in the short term. Their customers are loyal enough that modest price increases would not drive them away. But Costco refuses to do this because they understand that their pricing discipline is what builds long-term loyalty. The company has a rule that no branded item can have a markup above 14%, and no private label item can have a markup above 15%. They enforce this rule religiously. When costs go up, Costco absorbs the increase rather than passing it to customers. When costs go down, Costco passes the savings through immediately. This discipline is incredibly rare in business. Most companies maximize short-term profits. Most managers are incentivized to hit quarterly earnings targets, which encourages raising prices whenever possible. Costco has resisted this temptation for decades, and the result is a customer base that trusts them completely. Let me tell you a story about Home Depot that illustrates why physical retail can still thrive. A few years ago, I was talking to a contractor who does renovation work. I asked him where he bought his supplies. He said Home Depot exclusively. I asked why. Did they have the lowest prices? He laughed. No, he said, sometimes other places are cheaper, but Home Depot has everything I need in stock. I can get it today. And when I have questions, their staff actually knows the answers. I cannot afford to wait for a delivery or drive to 3 different stores to find what I need. My time is worth more than any price difference. This is the essence of Home Depot's competitive advantage. For professionals and serious do-it-yourselfers, time and expertise matter more than small price differences. Home Depot optimizes for these factors, and as a result, they have captured the loyalty of the customers who spend the most money. The company has invested heavily in their professional customer segment. They offer dedicated checkout lanes for pros. They provide bulk pricing for large orders. They offer delivery services optimized for job sites. They have sales representatives who build relationships with contractors and help manage their supply needs. Amazon could theoretically offer all of these services, but Amazon is optimized for consumers, not professionals. Their entire business model is built around individual orders delivered to residential addresses. Adapting to serve professional customers with different needs would require significant changes to how they operate. Home Depot has also invested in something that seems old-fashioned but matters enormously: store experience. They have widened aisles to make navigation easier. They have improved lighting to make products more visible. They have invested in training to ensure associates can answer customer questions. They have added services like tool rental and truck rental that increase the utility of each visit. All of these investments make Home Depot more valuable to customers and harder for Amazon to compete with. They create reasons to visit the physical store that go beyond simply buying products. Now, let me explain why AutoZone is such an attractive business that few investors truly appreciate. The auto parts aftermarket is enormous. Americans own nearly 300 million vehicles. The average age of vehicles on the road is over 12 years and rising. As vehicles age, they require more maintenance and repairs. This creates steady, predictable demand for auto parts, regardless of economic conditions. AutoZone has built a retail network of over 6,000 stores that puts them within a short drive of most American car owners. Each store stocks thousands of parts for the vehicles most common in that local market. This local customization is something a national e-commerce operation cannot easily match. But what really differentiates AutoZone is the service component. Walk into an AutoZone with a car problem you cannot diagnose, and they will help you figure it out. They have diagnostic equipment they will use for free. They have staff trained to interpret error codes and recommend solutions. They will loan you tools if you want to do the repair yourself. They will even install certain parts like batteries and wiper blades at no charge. This service creates customer loyalty that Amazon cannot touch. When you have a car problem, you do not want to search through thousands of products on a website hoping you find the right one. You want to talk to someone who can help you understand what you need. AutoZone provides this service, and customers reward them with repeat business. The financial results speak for themselves. AutoZone has generated returns on invested capital above 20% consistently for years. They generate so much cash that they cannot deploy it all profitably in the business, so they return it to shareholders through buybacks. The share count has decreased by more than 50% over the past decade. This capital allocation is exactly what I look for in a management team. They understand their business, they recognize when growth opportunities are limited, and they return excess capital to shareholders rather than wasting it on foolish acquisitions or expansion into areas where they have no advantage. Finally, let me elaborate on why Walmart is better positioned than most people realize. There is a narrative that Walmart is a dinosaur that will eventually be killed by Amazon. This narrative is wrong, and investors who believe it are missing an opportunity. Walmart has something Amazon desperately wants and cannot quickly build: a physical presence in communities across America. Nearly 90% of Americans live within 10 miles of a Walmart store. This proximity enables services that pure e-commerce cannot match. Consider grocery pickup. You order your groceries on the Walmart app. You drive to the store at your scheduled time. A Walmart associate loads the groceries into your car. Total time from arrival to departure is under 5 minutes. You have your groceries immediately. You did not have to walk through the store, and you did not have to wait for a delivery that might come when you are not home. Amazon has been trying to build this capability for years. They bought Whole Foods partly for the physical locations. They have launched various delivery services, but they still cannot match Walmart's combination of selection, price, and convenience for grocery shopping. And grocery is not a minor category. It is over $800 billion in annual spending in the United States alone. It is the most frequent purchase category for most households, and it drives traffic that leads to purchases in other categories. Walmart has invested billions in their digital capabilities. Their e-commerce sales have grown rapidly, much faster than their overall business. They have built a technology organization that rivals many pure technology companies. They have attracted talent from Silicon Valley with the pitch that they can impact more customers at Walmart than at almost any other company. The company has also been smart about where to compete and where not to compete. They are not trying to match Amazon's selection of tens of millions of items. They are focused on the products that matter most to their customers. Everyday essentials and groceries. In these categories, they can match or beat Amazon on price while offering superior convenience through their store network. I want to address one more important point about investing in these retail stocks: the valuation question. All four of these stocks trade at premiums to the overall market. Some investors look at these premiums and conclude that the stocks are too expensive. This analysis misses something crucial. In a declining industry, low valuation multiples are appropriate because earnings will shrink over time. In a growing industry with sustainable competitive advantages, higher valuation multiples are appropriate because earnings will grow over time. The four stocks I have discussed are gaining market share. They are growing earnings. Their competitive positions are strengthening as weaker competitors fail. Paying a premium for these characteristics makes sense because the premium will prove to be a bargain as the businesses continue to compound. Compare this to the struggling retailers that trade at low multiples. Yes, you can buy their stocks at 5 or 8 times earnings, but those earnings are declining in 5 years. The earnings might be half of what they are today, or the company might be in bankruptcy. The low multiple is not a bargain. It is a trap. I have learned this lesson repeatedly over my career. Cheap stocks in declining industries are almost never good investments. The industry decline continues, the earnings deteriorate, and the stock keeps falling. The multiple that looked cheap at 10 times earnings looks less cheap at 8 times earnings, and even less cheap at 5 times earnings as the business shrinks. Quality businesses with sustainable competitive advantages are almost always better investments than cheap stocks in troubled industries. You pay more up front, but you own something that compounds over time. The price-to-earnings ratio that seemed high in year 1 seems very reasonable in year 5 and downright cheap in year 10. This is the framework I use when thinking about retail investments. I want to own the survivors, the businesses that will gain share as the industry consolidates, the businesses that have advantages Amazon cannot replicate. I am happy to pay a premium for these businesses because I know the premium will be worth it over time. The 4 stocks I have shared today, Costco, Home Depot, AutoZone, and Walmart, represent my best ideas in retail. They are not the only retailers that will survive, but they are among the best positioned. They have competitive advantages that make sense. Management teams that execute well, and financial models that generate cash and return it to shareholders own these businesses. Hold them through the volatility that inevitably comes with investing in retail. Trust in their competitive positions and let compounding do its work. That is the path to building wealth in retail during the Amazon era. Everything else in retail is a gamble. It might work out. But the odds are against you when you are competing with the most formidable competitor in business history. Bet on the survivors, not on hope. That is how patient investors build lasting wealth.